All right, we're running an experimental video in this one where we're going to be screen sharing. Vel's going to be running through a framework of how to scale to 8 figures, and I'm going to hop in from here and there, asking questions, and I'll also dive into the relationship of acquisition, mirror, and spend, and how you can model advertising spend as you start to scale up from 1, 2, 3, all the way to 10 mil. I'll pass to you, Vel.
Awesome. Yeah, just to give some context, we're going to discuss what I call the profit operator framework or model. And this is basically the framework that I use with my clients to understand what kind of targets we're going after. Because I see a lot of mistakes being made in the space when businesses don't really reverse engineer their P&L. They just aim for a certain revenue figure and then go from there and hope that they turn a profit, when it's actually the exact opposite, right? You got to start with a specific profit target in mind and then go from there and figure out, based on your current metrics, what exactly do you need to do on your side to get to that desired profit. So I will share my screen now and we'll go through the framework step by step. All right, let's go. So again, it's a very simple framework, right? Nothing too crazy, and it should communicate the most important aspects of a D2C business model. So the first step is to understand how much money do you need to make, right? It's crazy. It's a crazy concept for most businesses, but what is our target net profit after all fixed variable costs, marketing dollars? How much should we have made in net profit? This is your starting point. Now, there's a step 0 that I've hidden. We'll get to that in the last sort of section of this framework, but you got to figure out how to calculate that net profit, and that's where the art comes into play, right? But let's say we want to make $400,000 for specific business needs. Now, the second step is to know what our OPEX is within that time period. So let's say your monthly OPEX is $125,000. You want to look at a 2-month period. It means that $250,000 will go out in OPEX over that time period. So your profit contribution target over that 2-month period is $650,000, right? So again, we take 400,000 plus 250,000, we get 650,000 in target profit contribution that we need to generate. Now, then the next step is, what is our marketing efficiency ratio, right? How much, and again, you can call it blended ROAS, right? What is our blended ROAS currently? Let's say it's 2.1. It means that we would need to spend $1.7 million in paid ads at that marketing efficiency and gross profit margin of 65.5% to generate $650,000 in profit contribution. So again, we take our gross margin, we take our marketing efficiency into account, then we take this profit contribution target and we calculate the net revenue and the paid ads budget based on that net revenue, right? So again, these two metrics are given. This is what we calculate based on these two metrics and this profit contribution figure. Now, I can share this calculator, so anyone interested, you can drop me a DM and I will share this calculator with you. But the idea is very simple, right? We know these numbers. Now we calculate the net revenue figure. So again, we don't start with net revenue, we start with the net profit first, and we go from there, and we calculate the net revenue target. Now, after that, you can take it a step further and say, okay, so our average order value is $65, then we need to generate $55,000 or 55,000 orders, or 56,000 orders if we round it up. And then you can take it one other step further and say, we sell 2.5 units on average per order, which means that we would need to sell 139,000 units. And again, depending on your product portfolio and the catalog and how many different products you sell, that could be distributed across different variants, different SKUs. So you would have to look at sales distribution and calculate the actual breakdown of units by product. But again, it's more advanced, right? We don't really need this section. All we need is this step 4. That's our cutoff right here. So we need $3.6 million. Now, here's where magic happens, right? What if our marketing efficiency drops by 0.3 down to 1.8. See what happens to the paid ads budget and net revenue, right? Huge increase. So if your marketing efficiency drops by 0.3 and you still need $650,000 in profit contribution, you would have to spend $3.6 million and aim for $6.5 million in revenue. Crazy increase, right? So look how marketing efficiency is absolutely important for you to generate enough profit without aiming for crazy numbers. Now, this is where the conversation about incrementality comes into play, right? What kind of money should we spend in paid ads to generate the necessary revenue at the desired profit contribution level, right? And that's where, Nathan, you guys come in at Blue Sense Digital, and you look at incrementality and say, okay, we might have to scale our budget to cover the OPEX and aim for a specific net profit target, right? How do we do so without losing too much efficiency, but also realizing that without losing efficiency, we can't scale the budget, right? So how would you guys approach it on your side?
Yeah, let me actually screen share, and I'll run you through how I'd be thinking about this problem. And I've got a nice pen and paper tool now, so I can draw live, which is nice. So every business, you can do this, and we do this with all brands now, is you take all historical data on daily spend and daily acquisition MER, and you can plot acquisition MER, and then you can plot spend. And so as you go to the right on the y-axis, you have days in which you spend more. As you go up on the x-axis, as you go up on the y-axis, you have higher efficiency. And so what this generally looks like is something like this, where on the days that you spent less, you have higher acquisition MER. And then as you come down here, you start to have a higher density of dots that are at much lower efficiency. And depending on how much data you input here, and depending on how clean the brand has been and how many different peaks you have throughout the year, and you can adjust this data set for seasonality, you end up having some kind of a logarithmic regression that lies within the data set. And so the obvious conclusion here is that as you scale spend, your efficiency will degrade to a point in which there will be no point in spending at that level anymore. And so there'll be a point in incremental acquisition MER in which you're driving negative profit contribution into the business. Now, you could theoretically run the business at 90-day profit or 180-day profit, so you're not actually repaying CAC for an extended period. But when you start to play that game, you're playing a very risky game, and you're putting a high risk portfolio and your ability to execute across retention post-acquisition. And so what you need to be ideally looking at is, where is your optimal level of spend based on your historical data, and what does the data set tell you and infer for the future? And so right now we're December 24th, and so we're in the planning stage for a lot of clients and looking at this data set and going, well, in January, we typically, for this example, perform 10% worse. And so we know that this is the optimal point of maximizing profit contribution. Or let's say that this is the point in which we do 650K in profit contribution. So exactly the example that Val was just running through. We know that if we go any further than that, there might be diminishing returns, or we get a slight improvement in profit contribution, but it's negligible in proportion to top line revenue. And so that extra volume, we might not want to do it anyway. And so from here, we can then determine the spend level that we should be at and how we should vary the spend on a month-on-month basis based on the inbuilt seasonality of the business. What will likely be the case, particularly with the example that Vel just showed there, is that you want to do $650,000 in profit contribution, but the curve says you can't. And so what do you do then? Because you want to go, the curve actually has to sit up here for you to go and spend 650 profitably, but the curve sits down here. So what do you do? How do you shift all the historical data points up so that you can build a new curve of efficiency? You can, if you've historically been doing marketing quite poorly, if you just have a lot of inefficient spend in the ad accounts, if you're not structuring things correctly, if you don't have a lot of creative volume and diversity, if you're not KPIing correctly, which is resulting in you optimizing for the wrong things, which is resulting in all of these data points, then there might just be some quick fixes. And there usually is in a lot of businesses where we could hop in and we could immediately shift the curve a little bit. But if you want to shift the curve a lot, and in this case, you might need to shift the curve a lot, you're going to have to start thinking bigger at a business level and be considering the product portfolio, be considering large changes in the marketing approach. Are we doing influencer seeding, for example, as an additional strategy to tie into the overarching acquisition strategy? You really need to start thinking bigger and broader to be able to shift this curve meaningfully in a way that, let's say at the moment, you can only generate 180K in profit contribution without going into negative incremental spend. How are we going to do a shift that big? And so that's kind of how I would be thinking about that problem in terms of what is our optimal MER that was mentioned on Val's slide. This kind of analysis will show you exactly where your optimal MER is currently with historical inputs. And then if that isn't where we'd like it to be, and if that doesn't align with the target net profit figure, well, then we need to start back propagating into how do we change the inputs to generate a different output so that we can shift the efficiency curve.
Yeah, it's very interesting. And the example I was showing as well, or the framework I was showing as well, is blended marketing efficiency. So you're showing acquisition marketing efficiency. How do you typically adjust for repeat business?
Yeah, so you would also want to do an extrapolation of returning customer revenue based on a cohort analysis. And so we do this as well. And it's relatively simple math. It's not hard to do, which is that, say this is all the cohorts over time, you can extrapolate these cohorts into today's day to be able to figure out of these cohort sizes, what percentage of them are going to return and how much revenue is that going to contribute into today's month. And therefore we can get a relatively accurate returning customer revenue number. I've found, and this is going a little bit too deep on this, but I've found that this number isn't fantastic unless you do a percentage adjustment based on the seasonality of the month that we're in, using historical returning customer revenue seasonality. That ends up giving you a really accurate figure. And then obviously you're layering these two numbers together to total up to total revenue.
Yeah. And that's where the conversation about cohort analysis comes into play, right? How do we actually take all the historical data and the efficiency of acquisition and extrapolate that into the future and understand the cash conversion cycle, the implications on the cash conversion cycle? Because you spend some dollars today, hopefully your first purchase profitable. So you take $1, you spend on ads. You also had invested in inventory, which had been sitting for a while, right? So you sell that inventory, then you need to generate the return on that customer on the first purchase, ideally, so that you take that return and you reinvest back in acquisition. And then the customer lifetime value continues growing over time to generate even more return that you take and reinvest back, right? So that repeat customers are becoming this self-fueling machine for you, right? That invest in your future acquisition. And the moment you are not first purchase profitable, that's when problems begin, right? Because you now have repeat customers compensating for the loss of new customers. And then hopefully you're recouping that investment within a reasonable time frame. And ideally, you want it to be, first purchase profitable. If you can't, then you have to turn profitable within 90 days, which is a reasonable time frame. And anything beyond that, it becomes very challenging for you to finance that cash conversion cycle. Because again, you also have inventory that you prepay before that. So the actual cash conversion cycle doesn't start when you acquire a customer. It's when you invest in inventory. And then it takes you 30, 60 days on average to sell inventory. And then you sell it at a loss on the first purchase. And then you kind of have to compensate for that, right? So repeat customers become this saving grace. And if you don't have enough repeat customers, it becomes a challenge. So what do you guys see on your end with customers or with your clients? Which types of customers drive the most value, and how do you take that into account as well?
Yeah, well, I'll tie back to what you said, which is that I have seen that more and more, which is that the lack of delineation between returning customer revenue and new customer revenue means that people are just running acquisition unprofitable, but they have no idea because the returning customer revenue profit contribution stacks up to where the business is profitable overall. But it's because they were running acquisition profitably like 6 months ago, and then it ticked into unprofitability, acquiring cohorts that'll never be profitable based on historical growth, but you don't see it. And so the business is just slowly dying, but you don't have visibility on it unless you have the understanding of being able to delineate those two types of customers and those two revenue channels. When it comes to high value customers and how we're kind of looking at returning customer revenue and how we're adjusting acquisition strategies there, we have a few customers that run on the basis of a 2 to 3 month CAC payback period. I still don't really like it. And the reason why I don't like it is that you have to have a really, really convincingly strong 12-month uplift in profit contribution to be able to have a relatively strong percentage EBITDA as a business running on a 3-month CAC payback period. And I've almost never seen a business, or I very rarely see them, that have strong enough returning customer rates. Because what ends up happening is if you have like this cohort that you've acquired, and these are the months over time that we're going through, and then you're acquiring, let's say you're acquiring them at $30, and then the initial gross profit is 25, and then it goes to 26, and then 27, and then 28. And that's relatively normal. And then maybe it asymptotes at about, let's call it 37, and then there's not much growth past there. Let's say that's the attrition period is 16 months in. It's taking you 16 months to make $7 on an order that might have been $70 in average order value. And this was the gross profit. And so that's a 10% contribution profit on a 16-month time horizon. It just doesn't seem like a very convincing ROI to me, particularly when you put into account just the cost of capital and the fact that that money could have just gone into an index fund and you would have gotten a better return. That it's like, why? I don't even know why you're playing that game of such long turnaround times in acquiring profit in the e-com space.
You just can't. That it's not sustainable. Like you will go out of business at some point, unless you have so many repeat customers from previous years coming back and just financing your whole business. If you start acquiring at a loss, you got to turn profitable within 90 days. It's not a question of if things go wrong. It's a question of when. And going back to this, how do we determine the net profit target? So I'm going to show the framework once more. And I think that's where a lot of businesses kind of go wrong, right? Firstly, they don't know the total target net profit that they need to aim for. But let's see, how do we calculate that? So the step 0 is to understand, okay, what kind of cash commitments do you have coming up, right? What do you need to cover? Let's say there's seasonal losses expected. So let's say this is November and December, the 2-month period we're looking at, and we want to generate enough profit for us to cover Q1 next year, right? Let's say there's seasonal losses. You are expecting a pretty poor winter, right? You are forecasting to lose $100,000. So then we need that $100,000 cash to be part of the target net profit calculation. Then there's net inventory purchases. Do we need to invest in inventory? Do we need to buy more stock as well on top of it, right? If there is a commitment, so let's say we need another $100,000 here, so then the target goes up, and you can see how the numbers change, right? We've got another $100,000, so now the profit contribution target is $750. But let's say we don't have any debt. We don't have to pay anything within that 3-month period next year, right? So maybe we go down to 0 here and cuts our requirement for profit contribution down to 600,000, right? Now we don't need to spend as much. Keep marketing efficiency the same. Again, it's a more complex topic. But let's say we do need to pay back 50,000. Okay, so that's another cash outflow that we need to take into account. Again, doesn't show up on the P&L. These are non-P&L items, right? Things that businesses forget about when they look at the P&L. Then there's planned CapEx. Are you planning to buy some equipment, machinery? Are you planning to make some investments on the capital side? Then we need to take that into account. If nothing, okay, move on to dividends, right? Do we need to pay partners, members in the company, some sort of cash outflow, right? A lot of founders, pay themselves a minimal salary, but then they take out some dividends to minimize taxes, right? That needs to be taken into account. And extra cash in the bank account. How much do you want to have in your bank account after you've paid all of these off, right? How much extra cash or extra safety do you want to have, or cash reserve, so to speak? So all of these things determine what kind of target net profit you need to go for. Again, the total is 400,000 here, and that's what would dictate the target net profit for us. And you would calculate all of these with basic forecasting, right? You don't have to go very crazy. You just need to have a specific plan in mind, financial game plan for the next 3 months to know where you're going to stand, how much cash you're going to need in that 3-month period. And again, if we take customer acquisition into account, and it will be reflected in marketing efficiency ratio. If you're losing money, then your marketing efficiency might go down, and that will dictate your paid ads budget and net revenue. And this is kind of like a two-sided thing. This is a marketing or front end conversation. This is a back end conversation, right? So instead of us, saying we need $650,000 in profit contribution, and then telling that to marketers and saying, okay, figure out a way for us to keep our marketing efficiency, spend reasonably, and hit those targets. Like you said, Nathan, you may not be able to shift that curve up, right? And you're going to say, look, we are going to lose more efficiency. Maybe it goes down to 1.6, and then we enter this vicious cycle of we have to spend more, right? To basically generate the same amount of profit contribution. And then it becomes like a whole derailing from there. It's an exponential derailing, right? So maybe the conversation should revolve around this. Maybe we lower the profit contribution target. So how do we play with these numbers, right? Should we invest less in inventory? Let's take a look at our product catalog, product portfolio, optimize that so that we don't have to invest another $100,000. Maybe there's a lot of overstock that we're buying, right? So the requirement might shift down. Seasonal losses, maybe cut our OPEX a little bit, right? Going into the 3 months. Maybe we should restructure our organization, shift people to part-time instead of full-time, right? During that low time period. And let's say we go down to $50,000 in seasonal losses, okay? Debt repayments, maybe we have a conversation with our Shopify capital, ask them if we can push our repayments just a little, right? To minimize that cash outflow. Let's say they cut it down to 25,000. Let's say dividends, right? Maybe go lower on the dividends side. Pay yourself 20,000, still respectable amount, but just not as crazy, right? And extra cash. Maybe we don't need $100,000 in the bank account, right? So maybe we just need another $50,000 because we have control over our operations. So now you can see how the profit contribution target has shifted down without doing any work on the marketing side, right? Now we have a more reasonable target to hit with marketing, and we can go back to the plot, the graph that Nathan showed, and look at how we can generate that profit contribution without spending unreasonably and keeping our marketing efficiency in control. Again, it's not about maximizing it. Let's go up to 2.5. This is very hard to deliver, but it's a reasonable marketing efficiency that we can actually maintain. So this is the type of approach we would take, I would take with my clients. Look at those numbers, right? And I highly recommend that you guys implement this type of framework into your operations because it will make you a much better operator. It will link your back end and front end, link your marketing with operations and finance. What are your thoughts, Nate?
It's a great way to look at it. Yeah, it really it opens the discussion between the back end and the front end, which is that marketing agencies are provided with targets, and then it's go hit the targets. But it completely puts aside what I just ran you through in terms of using historical data to infer a probable outcome in the future. And so that's what I really like about that framework that we use now, is that we can get a profit contribution number like that $650,000 number. And we can very easily just say, hey, completely unrealistic. This is what your historical data says. We need to shift the curve so far that this is out of the bounds of our scope. And so let's shift the discussion to step 0. Why do we need to be generating X amount of profit contribution? Is operating expenses too high? How is the business currently being operated that's requiring that kind of cash flow? Because I'll give you an example. We just started working with the business, and we have a YouTube video going out on this in about 5 days' time, where they were losing $60,000 per month in net profit when I first audited them. Right now, as of last month, they made $30K in profit. And one of the primary drivers of that was their operating expenses were $100,000 a month when this was a business doing $2 to $3 million a year. And their spend as well, there was a lot of wasted spend going on. And there were dividends being paid, which were outrageous too. And so it was a combination of these operational factors in combination with some poor marketing as well that led to a super undesirable position for the business, and they were about to go under. And it's through visibility over both of those two components of the business that I think allowed us to turn it around.
Absolutely. Yeah. And this is where things go wrong. Like the balance sheet, whenever it's not clean and you don't know where you stand and what kind of debt you're expecting to repay, what kind of dividends you're expecting to pay, what kind of inventory purchases you're looking to make as well, historically, right? You don't know half of the battle. You just look at the P&L. It may be green November, December, right? Maybe not, depending on how well you do during Black Friday, Cyber Monday. But it's the balance sheet that will dictate the rules on the cash flow side most often, right? Because we forget all these things in the back end, and they will kill your business. So the moment you understand the step 0, you look at the balance sheet, you know exactly what kind of cash commitments you have for the next 3 months. Then you can accurately estimate your target net profit, bring it to your marketers, figure out if there is a feasible way or a viable path to get to that number. If not, then like Nathan said, adjust your step 0, right? Go back to step 0, figure out how you can optimize on the back end so that you don't overextend. And don't push the marketing efficiency target unreasonably high.
What I also really like about this, just to make another comment on this framework, well, is that depending on how complex your cap table is of the business, the two real objectives of most companies is produce as much dividends as possible and ensure the longevity of the business.
Yep.
And on this model, it's literally the dividends paid row 6, maximize that as high as possible, whilst balancing for the fact that the business doesn't go under and you maintain the health of it.
Yeah.
And most people don't think or back propagate all of their numbers from that fundamental. Instead, it's, we just want to hit 10 mil revenue because we think we'll probably be able to maintain 10%, and then that will be $1 million in net profit. But that's not how it works, particularly when you have all the cash requirements within a direct-to-consumer e-commerce brand. You're not running at 10% net and taking $1 million off the table. It's just not how it works.
Yep, exactly. And that's the beauty of it, right? It's like you're in the business of making money for your stakeholders, everyone involved, whoever gave you money, whoever, is your partner. And that's what you said, like dividends are a major component of it. And what helps with this framework is that you look at the distribution of cash among different categories too. So you see, okay, so we have a ton more cash going out of the business into inventory, right? So let's say this is the situation, right? Let's say this is the situation. 0 in dividends, right? Then you kind of sit down and scratch your head and ask questions. Why the hell do we not have enough cash to pay in dividends? Why are we losing so much money? Seasonal losses. Why do we investing so much money in inventory? Can we optimize that better so that we can shift money around and actually pay stakeholders their money? And that's how you build a sustainable business, or like they say, cash flow in business, right?
Yeah, exactly.
Cool. So now I guess the last question is, how do we combine all of these things together to help businesses get to 8 figures? Because a lot of businesses struggle to break past that 10 million. What would you highlight?
Well, I think I've already highlighted a few things, which is just the bridging communication between operations, marketing, and finance. The You look at a calculator like this, and it's very easy. And I'm sure some people will grab this off you, Gal, and they'll just go and start plugging in numbers and change things. Like it's as easy to change that number as just changing the Excel dot. And the biggest one is column D, row 15, which is that marketing efficiency ratio right there. It's very easy, as you were doing before, just to flick that to 2.1 and then flick it down to 1.6 and see what happens. But the reality of being able to actually scale paid media spend whilst maintaining incremental efficiency is a completely different story. And it has so much complexity that underlies it. And so to simply push a figure to your internal marketing team or to an external partner and say, hey, this is just the reality of what we have to hit. If we want to be profitable, go hit it. You're building a relationship in which that marketing team isn't going to be able to have healthy pushback to show you the bounds of possibility and then be able to restructure the business and the operations accordingly. And that's ultimately the down failure of most marketing agencies, which is that you get given a figure by the business owner and the business owner says, you have to hit this or else. And then the marketing agency goes, okay, we will hit it. And then they don't hit it, even though they knew they weren't going to hit it the entire time because there wasn't a more open discussion. And so I think if the approach of a 7-figure business was just through the lens of what you've outlined and demonstrated here, I think it would be a much more productive way to start forecasting growth and planning finances.
Absolutely. And just to add to that, I think what I like to see is a matrix of potential values, right? So let's say we put together a little profit contribution on the y-axis and then marketing efficiency on the x-axis. And then we calculate all these different variations or different combinations, right, of potential values or potential outcomes. And then we actually take that and bring it to the marketers and ask questions. Which values do you think are the most reasonable? Where should we aim, right? As opposed to saying 1.8, 3.7 budget. Let's go, right? It's probably not possible, right? It's probably going to be like a range of potential values, right? So instead of just bringing one figure, let's say we build out a whole matrix of different potential values, 1.7, 5.9 million, right? All of these things taken into account. And again, I know it's crazy jumps, right? And paid ads budget needed to hit this target. And that's again, it's all about having a conversation, open line of communication with the marketers, operators on the back end. And to me, I think that's the most important. I think communication is what lacks in a lot of 7-figure businesses. They just do things in isolation. There's not much alignment. And the moment you link it back to what matters the most, which is net profit, because you take that net profit and you reinvest it back in the business, right? That's what fuels scale. You can't grow without being profitable. So you need to figure out how much profit you need to scale, and then you link every single function of the business together to actually come to that number. And that's what a lot of 7-figure businesses fail to accomplish because they think they can figure things out on their own or the marketers will take care of them, right? And everything runs in isolation, not much alignment, and things fall apart.
Yeah. What you said before was perfect, which is the combinations of MER and paid ad spend. That's why I think the profit contribution number is such a great number for agencies, because if you move the responsibility of the agency away from MER and paid ads budget to profit contribution, what you're doing is you're allowing the performance marketing agency to be able to decide themselves what the combination of MER and paid ads is that they want to be able to generate that profit contribution. And I saw a LinkedIn post by Chris Daly the other day that was saying how profit contribution is a terrible metric that agencies shouldn't use. And like, I couldn't disagree more, because profit contribution is just saying, hey, marketing agency or paid ads partner, or whoever you are, maximize my return for the budget that we put in and find the optimal point on that curve.
Yeah.
Which is exactly what you want to optimize for.
Yeah. Agreed. Yeah, I think Chris is just so far advanced. And I know what he's saying, but I think a lot of people just misinterpret that. But I know what he's saying, and what he's saying is extremely important, but just people don't understand that to to the detail. So it's let's just go back to profit contribution for now. People need to catch up to that, and then we can talk about more global things.
Yeah, I agree.
Yeah,
I agree.
that's awesome. So I guess final tips: make sure that there is alignment between operations and marketing to have a specific target net profit in mind, as opposed to just running blindly and setting a revenue figure that may not even be profitable for you, right? Focus on net profit optimization through backend step 0, right? Instead of just saying, look, we need this target net profit, take some steps to optimize that before you start spending money on ads. Third thing is optimize your cash conversion cycle. Focus on first purchase profitability. If you can do that, turn profitable within a reasonable time frame. Because if you don't, then repeat customers have to compensate for the losses. And that's not sustainable. At some point, you're going to need to borrow money or raise funding from investors. So once you have all those 3 in place, you can actually mathematically scale beyond 7 figures as long as you have product market fit and there is no, exhaustion, right? We're not talking about these strategic things like product market fit. Of course, like some businesses only sell one product and at some point the market is oversaturated and it no longer works. So you can't really break out of that 7-figure trap. So of course there's a case by case scenario, but if you have repeatable business or repeatable products or consumable products and you have other products being developed, then there's no reasons for you, once you have a loyal customer base and product market fit, to not grow beyond 7 figures, as long as you follow this framework and you create the alignment.
I agree. This was great. Thanks for putting this together, Val.
Sure. Any last thoughts before we jump off?
No, all good on my end.
Perfect. All right, guys. Let us know if you have any questions about the framework. Happy to share it. And Merry Christmas and Happy New Year.
Merry Christmas and Happy New Year. Catch you later, Val.
Cheers.